I was fortunate enough to partner with Chris Smith when I got the idea to build the 7 secrets of option trading. And it really comes from my background as a CBOE market maker. And it incorporates Chris's incredible audience at the Option Coach and Tom Nunemaker's incredible technological prowess, and the work that's gone into this presentation. We're proud of so much of it. And I'd like to introduce Chris Smith and Tom. Introduce yourselves and say hi, if you would.
Hello, everybody. Glad you guys could join us.
Yeah, nice to be here. This is Tom.
And we're going to use this presentation as kind of a round table in the sense that if there's a question and you'd like to put it into the chat during our presentation, we encourage you to, and every so often Tom will stop me and we can ask a question. But mostly going to work to present for the next 45 minutes and maybe 55 minutes, somewhere in there. And then we'll take questions, and hope you enjoy this presentation. My background is Chicagoan since I was born. When I got out of college, I took a job at the CBOE as a runner. A good friend of mine from my swim team had a tie tied around his golf shirt and a smock on, and I thought that was a lot better than the tie buttoned up all the way, collar buttoned, and I thought that would be a great, way to start my working career. Well, I worked my way up from a runner to a phone clerk to a market maker, and it was the time of my life, and options are my passion. And so I've started, subsequent to automation, mentoring students around the world. And I really enjoy when I can tell that someone has learned something, where the light has gone off. You know those aha moments that you have. And my hope is that sometime during this presentation, you will have one of those aha moments, and you'll gain a little bit of insight into one of these 7 secrets that I'm bringing you from the trading floor, and I'll explain what I mean by from the trading floor once I read the fact that this presentation and these strategies are for instructional purposes only. Actual trades are the responsibility of an individual to manage, and this presentation is for educational purposes only. So I hope that you can sit back and relax. Maybe you have a cup of coffee or a hot chocolate, and you have a pen and paper, and you write down some notes. And my goal is that you get one little piece of information that can help you out, help you grow, help you learn to trade when you turn on your computer tomorrow, help you build your at-home business, and continue to learn and grow as a trader. Some people that understand market making and what I did on the CBOE realize that I always had to have an options position. For the 17 years that I made markets, I always had an option position, and I never knew at any of these instances where a stock was going to move. So as someone who was a wholesaler and inventorier of options, I had a storefront where I had a partner who was my bosses, Ernie Nadich, Sam Salerson, and Andy True, and we were always encouraged to be long options. I know it's not it's not really popular to be long options. Options decay. But I made a great living doing trading that way, mostly because of the fact that stocks move around. You know, when people wanted to come to trade options, they had to come to our pit, and it was a lot different than it was now. And we'd use different nuances. You know, we'd try to scalp our stock versus our option positions, or we'd try to trade another option versus an option position, or we try to scalp that option. But our edge was that we priced options, and we saw all the order flow. So we could tell the supply and the demand for options quickly, and therefore we could move the price around up and down rather quickly because we knew if there was a flow one way or another. And that was our edge. That was the reason for our seat lease. We leased a seat with the exchange. Every month we had to follow our membership rules, act appropriately, have that tie tied around our neck, and have the ability to talk the options lingo and understand how options were priced, and that's how I made my living. I can still remember when I let my guard down and I was going to get engaged, and my wife and now wife and I went on vacation, and I was trading, I was making markets in a sleepy little name called Spyglass. And Spyglass, when we listed it, was a real hot topic. It was the second coming of Netscape, and it was supposed to be just fantastic. Well, when we listed it, it drifted from 20 down to 12 and spent about a year there. And I had a few short call options. I was short about 30, I'd say, calls. When the stock was 12, those calls were on the 22 and the 25 line. Well, as a means of describing the reason you have long option inventories all the time, while I was on vacation, the stock went from 12 to 30 one day, and the position would have been fine if it would have been up to 17, 20, 21, but it went to 30, and it was impossible to get out of that position. So the difference today is that you can choose your strategy, and you know how many long calls versus how many short calls you have, and your position is much more defined than it was when we were making markets. We often had stray options that were very difficult to get out of. And you know, that was part of the reason we felt that we needed the edge to price the options. As exchanges started to compete, however, we found that there was no edge in standing and inventorying options. And today, you'll notice that most people put on a position. They buy a call, they buy a put, they do a spread, they do a condor, they do a butterfly, they do a time spread, and that's their position, and they manage it. So with that in mind, I can apply the market making method of trading options to individual positions, because the complex positions break down into their simplest common denominator, and really the basis for option trading comes from the basic knowledge of spreading options and the basic knowledge of how to enter an order and how to manage it. So I feel like I'm talking to you one-on-one, no matter where you are in the world, and talking to you from my heart when you say, I'm not here, when I tell you, I'm not here to really dazzle you with my experience, but give you a few insights into what I've learned, in my experience from trading options. So I encourage you to, if you have some predisposed notion about market makers or professionals, I encourage you to just open your mind and sit back and you know, this little analogy on the bottom of the slide reminds me of the fact that I remember there was a rookie trader in our crowd, and he did a big trade, and he put both arms up on the ledges of the pit, and he said, and I remember him saying, I love this position. I collect so much decay. That's amazing. The kid went to lunch, and my friend Jason Mucklow says, show me a guy who's in love with this position, and I'll show you a guy about to lose a fortune. And that guy did. And the bottom line is, there's no loyalty to your positions. There's no two instances that are exactly alike. You ought to just do the math behind understanding options. And that's what we're going to do for the next six Tuesday nights at 7 o'clock Central, is that we're going to share one of my 7 secrets of options. I'm going to give you one tonight, and then we're going to move on and share the 7 little secrets that I have. And one of them is that there's, today with 13 exchanges competing for your business, you are in a better position to pick, choose, sort out trades, analyze them because of the technology that's available to you. Break down and break through all the technology to understand the math behind options trading. Whether you have a PhD or you're just a regular guy that has 3 jobs and 2 kids and 4 cats, and it doesn't really matter, because it all comes down to your ability to break down the math and understand option trading strategies. When I was trading, I had a great boss, and his name was Andy True, and he was from Queens, New York, and he would always brag about playing cards in an old brownstone in Queens, and he would kind of indicate to me, and he would tell me, you know, trading is a money game. It's not a lot different than playing poker. You know, no one cares what your opinion is about a stock or a trade or a chart. Really, it matters whether your trade is actually going to make money. And I'd have these conversations with Andy, trying to draw him out to try to learn why he was the way he was, you know. And it would always come back to the fact that, you know, trading is a money game. You know, all he wanted to do was make money. Oftentimes we digress just a little bit about his kids or about the Cubs, and it always went back to the fact that trading is a money game. And you could be have all the higher education in the world, but the bottom line is that options education is something that, you know, is taught in very few universities. And when I got my MBA, I was amazed that there is such a divergence from the stuff that you learn in higher education versus the things that you learn on the trading floor. On the trading floor, there's 5,000 guys sharing information, whether incidentally or someone telling you in a management perspective how something works. But the beauty of the trading floor is that with 5,000 people there, you really learn how the markets work. You really learn how the options work. People described to you and shared with you how to trade, how to learn options. You know, that was beautiful organic economic growth. And today, you find that you have to go look on a website, or you have to, you know, read a book. But even if you read a book, you're just getting that author's perspective. Now, when you're working with 5,000 guys, you know, let me just be clear, 4,000 guys, 1,000 women probably. So, you know, it was male-dominated, but at the same instance, no matter who you talk to, people shared that information. You grew in a family of understanding option trading. And today, you really don't have that sense. You can do it on LinkedIn and talk to people and text people, and it's just amazing how the people on the floor shared information. In fact, I just took the Series 7, and I realized how obtuse some of these questions were that were on the exam. These are people who never traded, never really understood how trading works. The value of my mentorship or of this presentation is that it's coming from the guts of from where the money was managed. And from my experience, there's nobody except the people that have worked in and around the floor and the guts of the exchanges that really understands how to manage the risk of this. And I must sound incredibly egotistical, but I'm actually incredibly humbled by the ability to speak to people around the world and share my knowledge. And, you know, honestly, my goal is to travel the world teaching people options. So if you're calling in from Australia and you see, and go to my website and you'll see that I'm going to be in Australia, hey, give me a text or send me an email. Tell me you're going to where you live, and I'm hoping that we can run into each other and connect, because the people on the floor always wanted to share their knowledge of options, mostly because of the fact we knew that there was maybe 10, 20, 30% of the whole world that understood options, and that the world looked to the CBOE and to learn options. And our goal was always to be an ambassador of options knowledge to the world. Really, it's amazing. I did a presentation last fall with the Chicago Institute of Investment, and people just clamored to hear all the complexities of options and how to use their trading platform and why they would do things on their platform. There's nothing really complicated here. I can explain it. I'll take the time with you. I'm happy to do it. You know, this is my goal. This is really what I want to do with my life. And I could start off by telling you that, again, today the playing field is more level than at any time in the history of trading, of all varieties, with streaming quotes and former self-regulatory private or firms like CBOE who are now public, and the CME that's now public. These exchanges compete for your business. So the idea of inventorying options is gone. It's automated. The volume and the open interest of option contracts has subsequently skyrocketed. I can remember being on a CBOE subcommittee that was in response to a SEC probe as to how we could level this playing field between traders and individual investors. And that was, I think, back in 2002 or 2003. And the reason I say that is it's amazing if you think of the way things worked back in 2002 and 2003 and where they are today. When you have a trading platform and a couple of screens available to you, you have the technology and to make intelligent decisions. I just think everybody needs a little direction. I think everybody needs two heads maybe, or the ability to not be an island, to talk back and forth with one another about exactly, you know, why a trade works, and have a little Jiminy Cricket on your shoulder to answer your questions as to maybe why not this is going to work, because you get involved, you get enthusiastic. Hey, this is going to work. Well, you know, I'm here to be not the devil's advocate as much as the guy that could show you both sides of it, and that's really my goal, is to not be just the premium seller, but also show you the premium buying side of things too, because, you know, with implied volatility at all-time lows, there's bound to be a spike up, and sooner rather than later. So my goal is that every Tuesday night that you come, this will be your MBA for 2014. And I'm not giving any tests. My hope is that you'll just take one little nugget of gold, one little something that you can get from my teaching, from my presentations, to give you a tip, a secret, an insight into how other people did it differently. So you're not that island. You're not. You're with a group, a virtual community of a lot of people that have the same questions and the same sentiments as you. I'd be kidding if I said that when you're all alone in a room, you know, it's easy to get really anxious when a stock moves around and you're short premium, or doesn't move around when you're long premium. In either case, my hope is that you'll just get one little nugget of gold and it'll work out for you. So the first of the 7 secrets of option trading is really, it's the guts of why I lasted so long on the trading floor. I try to give myself so many ways to win, whether the stock had to move around, or it had to sit down, or the volatility had to go down, or the volatility had to go up. That wasn't enough. My goal is to give you a tip that maybe you could use in case, you know, you have a position on and you're all alone and you're struggling for what the next right thing to do is, you know, how to manage a trade, or how to get a trade working for you. And the first tip is this. If you're a short premium trader, most people are. Most people like to sell options. A lot of people say, well, we're putting the casino odds in your favor. Well, you are, if you think about it, because if you sell an option first, you know, the volatility is bound to go down, or not the volatility, but the option premium is bound to go lower. And my thought is that for premium sellers, you're putting the casino odds in your favor that volatility is, that the premium and the options are going to go lower. But it's a bet too. It's a short volatility bet. So if you're a delta neutral trader, or if you have 2 time spreads on, or whatever your position, if you start delta neutral and you start short premium, you ought to lean a little bit short delta. Now you're saying, how much short delta? When is this? When do we get to the meat of it? Well, let me show you this on my Thinkorswim here, and tell you that my encouragement to you would be that you should lean never as longer. You should lean never shorter than 1 day's worth of decay. Okay? In other words, you don't want to bet a whole day with your delta on being wrong. But remember, if the market goes down, volatility is going to go up. A short condor position like this one is a short Vega position. So if the volatility goes up, because the underlying is going down, you ought to be short just a few deltas, not a bunch, just a few. Okay? And let me just say something else. If let me go to another trade. If, on the other hand, you're a long premium trader, just the opposite happens. Because volatility comes in on the way down, because volatility comes in as the underlying goes higher, you ought to lean a little bit long into that long gamma position. Okay? Now, the goal is that you will not get affected as much because of the fact that you have a long premium position if you have long deltas. So long premium, long deltas, short premium, short deltas, okay? So at least you're doing the right thing with your delta. Because if you normally trade delta neutral, you know, and you're long deltas and short premium, it's like betting on the same horse in the same race to win on two different tickets. Now, it's not wrong, but it's more, to be more neutral would be to stay a little bit short, and it's more profitable that way. It's more of a flat position, okay? And again, with long premium trades, lean a little bit long into it. Because, by the way, on the way down, you're also going to benefit from the fact that volatility exploding with that position is a really, really, you know, it's really what you want to have happen, because back spreads and long straddles and long strangles are all long premium trades. So we all know that the volatility index is at a really low ebb. And my thought is to you that this low ebb is going to end at some point. So I want to just explain the fact that you could have both sides of that trade, you know, long and short premium. And I want to give you a little example that I have here. One of the stocks I made markets in was Biogen. And I'll never forget the day that we had a guy who had an infinite supply of the 90 calls to sell at $1.50. When the stock was 86 on the open, we had an offer on the 90 calls for $1.50. Now, it wasn't, that's fine. That was about a 40 implied volatility. That's kind of the low end that we ever saw with Biogen. But what really hurt us was that that was our bid. And so we bought some when the stock was 86, and we were trying to hedge, you know, and unless you hedge right away, you're just getting longer and longer. Well, lo and behold, 2 p.m. came around. Once 2 p.m. came around, the seller of the 90 calls was still at $1.50. And the implied volatility had gone down from 40 to 25. The stock had gone up, the implied volatility had come in. Any stock that you'd sold to neutralize your delta, any other options that you'd sold to neutralize your delta went, you know, just didn't work, because this one particular option, this one particular customer had a axe to grind on the 90 calls. Well, at the close of the day, the stock was about 88.5, and I think I inventoried maybe 300 or 400 or 500 of these options, and I had sold stock and I had lost money because these options didn't move, and because I had to be neutral and I didn't have a lot of other options to sell against it. It was pretty thin at the time. But by virtue of the fact I was buying calls and selling stock, I was synthetically buying puts and making puts synthetically by selling stock versus my long calls. That weekend, that was a Friday that this happened, and that weekend there was a news story that came out that Biogen and Elon were working together to mix their drugs up before they'd come up with Tasubre, and they'd killed some of these people that had tried this new combination of Biogen, IGEX, and Elon's drug. The stock went from 88.5 to like 38.5, and it was one of my best trading days because I turned over so much inventory. But my point is that in this instance, you can see where as the stock goes up, if the delta of an option does not move as you expect when you put it on, that's an indication of a volatility change. If the option doesn't move as much as you'd expect. It moves less than you expect. Well, then you're seeing a volatility crush. If the option moves faster than you think it ought to, then the delta shows you on your platform, well, then that's a volatility increase. And I just wanted to relay that little story as a means of doing it. So, anyways, is there any questions, Tom? Are we good there? Or how are we doing?
Yeah, keep going. I don't really see any questions.
Okay.
Oh, wait, there was a hand.
Okay.
Look. Let me get out of here. 1 second.
All right. How'd that sound, Chris? Any good? Did you write down any notes?
I did. I thought maybe folks might appreciate hearing a little bit more amplification on the ratio, but it looks like you're about to get into that right now.
Okay. Yeah. Well, you know, another thing I look at when I trade is my gamma to theta ratio. Gamma, the rate of change of your delta, theta, the amount of decay that you have in your option position. I wonder if I could give an example here. Here's my Thinkorswim again. This is a good example right here. And you know what? I've got another example I'm going to start with. All right. Okay. So I hope this Thinkorswim is coming through clear, because I want to show you the fact that if I do a position, here's how I'm going to explain the gamma theta ratio. I'm going to use this Thinkorswim as a picture of it. If I have a trading position on, or if I'm trying to examine whether I want to do a trading position, I look at how much gamma I get versus how much theta I get. In this instance, I sold 10 straddles, or strangles here, straddles, okay. And I have almost 500 short gamma. So every 1 point move means a 500 delta change. So, and for that privilege, I collect not quite $7 a day. And I hate this ratio. I always think that if you're going to do a position and you're going to take on short gamma, your theta ought to be 3 or 4 or 5 times as much as your gamma. Let me show you a Russell position. Okay, here's our little Russell Condor. In this instance, I like this ratio a lot better because of the fact that I only have a fraction of a gamma, and I have this, I collect $23 a day. Now, when I'm putting this position on, this is one of the little nuggets of gold, hint, hint, that I look for. I want to put, to give myself more of a way to win, I want to make sure that my gamma is just a fraction and that my theta is dollars, big dollars, this kind of a ratio here, okay? So that I can not worry about having to adjust my position all the time, because the rate of change of this gamma is really the change in my delta, and therefore it's unmanageable if you're in that position that I described in Nokia here. Let me give you another example here. What about my Micron position here? All right. Now, a lot of people don't like decay like this, but I want to tell you that this is a position that that can work for you. Well, why? Well, your gamma is positive 325, and it sounds crazy, but every day you have to make $45, whether it's scalping the stock or increase in volatility. But the point is that you can do it because of the fact that you have so much gamma and that it doesn't cost that much money. Now, I know that sounds nuts, but let me just tell you that when you look at your gamma to theta ratio, the amount that you pay out or collect versus your gamma, if you're short premium, you want your theta to be exponentially greater than your gamma. If you're long premium, if you're a back spreader, you want the theta to be exponentially less than your gamma. Okay, huge dollars less than your gamma. Okay, so that's what I know. All right, so put the gamma theta ratio in your favor. Again, short premium, they ought to have twice, 3 times, 10 times the amount of premium that you collect versus your gamma. Long premium, you want to make sure you just have a half, or you can have like in that example, 400 gamma costs you $40 a day, like a 10-to-1 ratio. That's really what you want. And the reasoning is because if you don't have that, for example, can I give you an example? Capital Cities ABC traded in my crowd, and it was a $700 stock. And for 50 long gamma, it would often cost you $500 or $600 or $700 a day. It was a ridiculous amount. No one wanted to trade it. No one wanted to trade it. It's just not worth it. And my hope is that if you take that little nugget of gold into your trading, it may eliminate a whole bunch of trades that can help you make smarter trades. All right, so with a long premium trade, you don't want to use a stock that's like $2 or $3 or $4. They're just not going to move enough. And the goal is that you pick up a stock that's somewhere between $10 and $40 a share that's got a volatility in like the low 20s or the low single digits. And I would backspread stocks that are more volatile. Your Cliffs Natural Resources and your stocks that really move around a lot. And your Microns have just had a really nice move. Something that's in kind of a sexy, crazy industry. Okay? Where are we at? Let me see. So what we're going to do is I'm going to kind of outline exactly how this is going to work. Starting this Tuesday, January 14th, we're going to give people a presentation every Tuesday night. We're going to give you one little tip, and I hope it helps you every night. Take some notes, and the bottom line is, if you were to look for some mentoring, it may cost you $125 or $250 an hour. Whereas with our group here, we're going to have just a question and answer session. We're going to have live access to questions, and we're going to give you that personal touch so that we can customize this presentation to exactly the way you trade. You really you'd be paying tons of money for that if you were doing mentoring. I live between UIC and Rush Hospital on the near west side of Chicago, and I looked into it. If you took a course at UIC, one course, they're asking $4,300 for one course, and this is not what we're asking, And if you found yourself in one of these trades that just didn't work, that might end up costing you, like $5,000, depending on the size of trades you have. And normally when people do these kind of presentations, they cost a lot more. But we're going to really break this down so that we can really get to your exact problems and help you figure out exactly what fits your trading style. And give you little nuggets that I've learned in my 20 years on the floor. And my encouragement is that you sign up for this. Now, you can do nothing right now and, leave the meeting and go your own way and be your own island. And you know what? A lot of people are very successful at that. But at the same instance, I tell you that what we're offering is more than nothing. It's just one little nugget of gold, that you're able to gain every night. Now, you can also keep doing what you're doing and maybe keep making mistakes or maybe stop once a week and look at this as a grad school class, as a way of growing your business or adding tools to your toolbox and building out ways that you can get better at it, And, you could, and the third thing you could possibly do is maybe is to buy a class and get a little trading insight. What we're offering is not going to cost $1,500. Through partnering with Chris, what we're offering to people is a lot less. What we're offering is access to a question and answer session and a PowerPoint that describes one little secret from a floor trader. We're also offering you our 7 Secrets Golden Book, which you can have and download and print out and take notes on and help organize your thinking, organize your thoughts, help you grow into something new. And we're also going to offer you 6 months of personal email support. And my hope is that you'll really gain something from all the mentoring sessions that we have. And then if you have a question and you don't want to ask it while we're doing it, that you can, ask it to me in an email. I'll give you my email, and that you'll take this golden book. And the benefit to you is that you're getting insight that isn't written by one author. It's written by a group of 5,000 of us. It's the collective knowledge of everybody that I worked with over the years at CBOE. And we have and what we're doing is we're pricing this at $447 for the next 6 weeks to get the recorded access to all these meetings, so you can download it, listen to it wherever you want to do it, or if you miss one, you could download it and listen to it at your convenience. You're going to get the 7 Secrets Golden Book, which is my little insights written down, as a message to you, and how this trade works or how it doesn't work, and maybe things to look out for, whether they're binary events or not. And you can also ask me a question, and my hope is that through all these methods, you'll gain, you'll build, you'll develop your business. And 2014 will be your year. And we're offering this $447 price for the first 25 signups tonight. And there's a limited amount of space in every room every Tuesday night. And it'll be for an hour, hour and a half, similar to the way tonight is. And my goal is that you'll try it out. Chris, what did I miss? I must have missed something.
Well, what I'd say, Casey, is, when you and I talked about this, and a lot of the attraction to bring you on here was that we have a very large community of people who are really excited about and passionate about trading options. And one of the recurring problems that I see is, people will jump into a position, whether it be a iron condor or other type of position, and the trade doesn't go their way, and they don't have the tool set available to really know how to manage it. And we talk about concepts of like managing by the Greeks, and we talk about concepts of adjusting positions and that sort of thing. but a lot of it, you know, we don't get the dots connected as traders. In other words, we don't really have a fine sense of how we use the Greeks for monitoring and managing the trade, or how to adjust the trade so that we stay in control of it. Too often I'm receiving emails or message board posts from people who find themselves in a difficult spot and they don't really know what to do. And so a big part of this was to bring in somebody who was a very good, experienced trader of many years' experience, who had the benefit of this collective knowledge and wisdom of 5,000 traders over many years trading in the pits, and be able to share it with us at a cost that is not going to put a deep dent in anyone's trading account. And if you were to sign up for there's some really good mentoring programs out there, you're probably going to spend several $1,000s in one of those programs. There's some good, very good courses that typically cost a couple $1,000. And what I did with Casey is talk to him into pricing this so that we could get it at a price level that I think makes sense for just about anybody who's really at a point where they want to learn how to manage these trades and keep themselves out of trouble. So when Casey talks about avoiding one catastrophic trade, catastrophic in my book is we know that you need to be able to anticipate or deal with a 50% decline in the stock market. It's happened twice in the last 10 years. There's nothing that says it won't happen again. That kind of loss can be catastrophic to an investing or trading account. $5,000 in a small account could be catastrophic. If you're trading larger accounts, the numbers just kind of multiply. So if you can spend 7 nights with someone like Casey and then have access to him for several months by email to ask questions and follow up at $447, it's a I think I haven't seen any deal better than that out there anywhere. The big caveat, though, is the WebEx platform is not free, and Casey's got 25 seats available. So the first 25 people that sign up will have a seat for the presentation. If you're number 26, you're not going to get a seat.
Well, thanks, Chris. I appreciate that. And, we're excited about this format, mostly because it allows the people that have questions to ask questions. And so my hope is that Tom is monitoring the questions and that there are some questions out there.
Yeah. Casey, there was one, Eric asked, he said, yeah, but NOK is a low dollar stock. What are the odds of implied volatility that will move even a point?
I'm sorry, there was clicking on, what are the odds of what?
What are the odds, implied volatility in parentheses, that it will move even a point for NOK?
Yeah, that's a good point. You just don't know. And I think that's part of, I just picked that as an example of a bad gamma theta ratio because of the fact that the stock could move around so darn much that it might, it would just be impossible to manage that. And that in the example of Nokia, it really, let's talk about that. If the volatility goes down 1 point, you make $32. Well, that's great. But if the stock moves around up or down $1, I mean, your delta changes and your money will change so dramatically that it really won't matter, because this volatility change will be so small. And I don't know what the odds of the volatility changing up or down are in Nokia's, because, you know, honestly, it really depends on the supply and demand for the options. And, you know, another thing that happens that changes the volatility is the earnings. You know, as the earnings come up, as it gets closer to that date, well, the implied volatility increases. And the thought is that you just, you don't know when it's going to happen. And if you found yourself in this position with so much short gamma on such a, and so much, and not nearly enough theta, I think if I was to have 475 short gamma, I'd want to collect $5,000 or $10,000 a day at the K. I mean, there's just no way I would do a position like that. Did that seem to answer it, Tom?
I think so. We had another question from Andy. He said, if you were reverse gamma scalping, are those ratios the same?
If you're reverse gamma scalping, well, you mean if you're long, first of all, you would be reverse scalping yourself in a position like this Nokia, wildly back and forth, back and forth, back and forth, because of the fact that your delta just changes so great. Whereas in a position like this Micron position, to ask me the question in reverse gamma scalping, Tom.
Yeah, he said, if you were reverse gamma scalping, are those ratios the same?
Yeah. I guess, Andy, you're going to have to ask me that question again, because reverse gamma scalping, I don't understand. Because if you're long gamma, your delta is always moving for you, always moving in your favor. You know, you see that in this instance here, if we're pretty darn close to flat, but if we move up to, let's say, 25, boy, we get long deltas fast. Or if we move down to 22, we get short deltas fast. So if the stock went down, I have opportunity. The position is working for me because my delta is getting shorter and shorter and shorter. And volatility is also working for me on the way down. How about this instance? If the volatility in this Micron position goes up 1 point from where it is right now, up 1 point, I pay for my theta right away. Why? Because my options will be, vega is the rate of change of your position, of the money in your position for every 1 point move in volatility. So in other words, if volatility goes up a point, the implied volatility of those options, I make $42. If it goes down, I lose $42. But I have a much better chance of winning or even losing less if I have a ratio like this where the vega is so close to the theta. Oh, and by the way, the gamma is so much greater than the theta. And I'm leaning a little bit, it just happens that I'm leaning a little bit long in this position. So if the volatility goes down 1 point, but the stock goes up a point, I'm still going to make money. So there's relationships with this long premium that have a lot to do with why the Greeks are what they are, why a long delta is the appropriate way to lean for a short, for a long, for a back spread or for a long straddle position. And why, and it's the same reason why in a Russell Condor, so many people love this ratio. Look at how small my gamma is here, but I get a lot of money. I get a lot of bang for my, I call this bang for your buck here, where your gamma is less than 1, but your decay is huge. I like that. Even in this instance, though, 1 point increase in volatility kind of wipes me out. I don't like it as much as the Micron example, but I can tell you that I think you have a much wider range within which you can profit. I think you have a lot better chance of profiting with your theta almost $22, $23, and your gamma, just short a fraction. How's that sound,
Okay, Andy had a kind of a follow-up question to that. He said, if you had a short straddle on the SPX and it gets away from you, would you anti-scalp on the spiders with those same ratios?
If it gets away from me, you know what, Andy, I tell you what, you can email me and we can talk, but I think if it started to move and I was short straddle, you have to, there's a lot more to it than that, and it started to get away from you. My thought is that if it started to move too far, too fast, away from my center point, I would just try to get out and reposition myself. And one of my other secrets coming down the road is, has to do with, your timing for selling or your timing for buying. And my thought to you is that that's coming. And my thought to you is I would rather get out, reposition, live the fight another day rather than, filling myself with emotions or pointing to a chart and saying, hey, it's going to go up, there's support right here, let's just hang on. No, I would encourage you, if it's getting away from you and your short premium, it's better to act sooner rather than later.
Okay, next question from Ben. When do you buy straddles? If IV is low, then the stock won't move much. If IV is high, then IV might explode and lose in either case. What are the metrics?
Well, keep in mind, Ben, that implied volatility is based on option volatility. Implied option volatility. That is an indication, a forward-looking instrument that looks at your options, whereas historic volatility is based on the underlying movement of the individual equity or the index. So if the implied volatility and the historic volatility are in line, or the implied volatility is at a discount, it is, relatively speaking, inexpensive, whereas if it's at a big premium if the option implied volatility is at a big premium to the historic volatility, well, then it's high, and then it's going to revert back to the historic volatility. So I don't think that low option implied volatility is an indicator that a stock is not going to move. I think it's low option implied volatility is an opportunity. I think you have to look at it a bit like that, because it's an opportunity because the volatility is low. And it's a forward-looking instrument. You're buying going forward because your options are alive and in your position like caged animals, waiting for that movement. You just have to remember that a long volatility position is long vega. So you have to remember when you put that position on, well, in Micron, I bought a 36 volatility. That it's got to go up from there. And every day that I have this position on, it's going to cost me $47. So if I bought a 36 volatility and it goes up a point, well, I ought to make, about 42, 43 bucks. Whereas if it goes down a point, and let's suppose that spot that we bought it at, what did we say it was, 32, 36, that it was really low, the chances are that it will go higher. And the same instance is if you find an implied volatility that's way above the historic volatility, chances are it's going to come back down to that historic volatility. Because remember, historic looking backward is the way it's always moved. So if you find an instance where the volatility is way above, the implied option volatility is way above the historic volatility, well, that's probably more in line with your opportunity to sell it. Whereas if it's at even with or a discount to the historic volatility, that's a good chance to buy the implied volatility. Did I give away another secret? No, I didn't. But it's just...
All right, a question from Christopher. He says, what are your thoughts on paper trading until greater mastery is achieved?
Hey, I can say this, amen, brother. I highly recommend that you paper trade for a while. I highly recommend that you practice everything and you study it before you do it. I think that the event that it's more, I think the big brokerage firms tell you, because more and more of them are coming out with simulated trading accounts. I mean, the first one I ever knew was OptionView, and it was amazing, you know, how many people use the backtesting facilities, you know, the paper trading facilities. A lot of them have different nuances, whether you're backtesting or whether you're paper trading, but they're very similar. And I personally recommend the paper trading versus the backtesting, but, you know, that's just my personal preference. I think you ought to paper trade, you know, a month, 2 months, 3 months, 5 months, depending on, you know, how comfortable you get with it, how good you are at it. Does that make sense?
It did. And that's it for the question.
Okay. Chris, what do you think?
Well, I think we pretty much covered what we set out to cover, and we did record this, right?
Yep.
Yes.
So everybody who's signed up, anyone who registered for the presentation, will get an email out to you with a link to the video replay. And to the extent there are available seats for Casey's 7-session training, we'll have a link for that as well.
Yeah. Hey, Chris, I want to say thanks. Maybe I can explain a little behind the scenes. You have a little conversation going back and forth across the country, working this presentation up. It doesn't happen overnight, and Chris, your support was great, and I enjoy it. I've been a member of your community for a long time, and I've enjoyed it, and I think you do a great job. Thanks a bunch, pal.
Oh, my pleasure.
Good. Okay. Tom Nuttermaker, behind the scenes, he's the guy that doesn't get any credit. He's kind of the director of the driver of the ship and the director of the show. He doesn't get enough credit either. Tom, thank you so much for doing all the things you do, and you know, I hope you enjoy this. I hope you sign up, and I'm happy to field your emails. You can go to my website. My email, casey@theoptioncoach.com, is on there. And in the meantime, have a good night. Good luck trading. And we'll see you Tuesday night, 7 o'clock Central. And I got a few more little insights that I can give you, and I hope they work for you. Good luck trading. And we'll talk to you all real soon.
Thanks, Casey.
Thank you,
Good night, guys.